Imagine this. You've worked hard to save rupees. 10 lakh. Now, you have a choice to make. Should you park it in a safe bank fixed deposit or take a calculated risk with mutual funds? What if the wrong choice means missing out on your dreams, be it owning a house, funding your child's education, or enjoying a stress-free retirement? This decision could define your financial future. Today, I'll guide you through the battle of bank FDs versus mutual funds. Stick around till the end, because the conclusion might surprise you. Let's start by addressing the elephant in the room. What do you value more, safety or growth? First, let's talk about bank FDs, a trusted favorite for generations. When you think of safety, stability, and predictability, FDs often come to mind. They offer fixed interest rates, guaranteed returns, and insurance protection of up to rupees 5 lakh under the Deposit Insurance and Credit Guarantee Corporation, DICGC. But let's be honest, when was the last time anyone got rich by saving in FDs? In 2024, FD interest rates range from 6% to 7.5%, depending on the tenure. However, there's a catch. Returns from FDs are fully taxable. So if you're in the 30% tax bracket, your effective returns could drop significantly. Here's the harsh reality. With inflation hovering around 6%, your FD might only just be keeping up with rising costs. Are you really growing your wealth or just running in place? Now let's shift gears to mutual funds, where the potential for growth is higher, but so are the risks. Mutual funds pool money from investors to invest in stocks, bonds, or other securities. Unlike FDs, mutual funds don't guarantee returns. But here's the trade-off. Over the long term, equity mutual funds have historically delivered 12 to 15% annualized returns. Sounds exciting, right? But don't start dreaming of a private jet just yet. There's more to it than meets the eye. The beauty of mutual funds lies in diversification. Your money is spread across multiple assets, reducing the impact of a single loss. Plus, there are tax benefits. For equity funds held longer than a year, gains up to rupees 1 lakh are tax-free, and anything above is taxed at just 10%. Debt funds have their own tax advantages if held for more than 3 years. Imagine your rupees 10 lakh growing to rupees 50 lakh in 20 years. This is the power of compounding when invested wisely in mutual funds. But here's the million-rupee question. Are mutual funds really worth the risk when compared to the safety of FDs? It all boils down to your risk appetite and financial goals. FDs offer certainty but may struggle to beat inflation. Mutual funds, on the other hand, carry risks but can generate inflation-beating returns over the long term. Here's a quick test. Would you rather have rupees 1,000 guaranteed today or rupees 1,500 in a year with a 90% chance of success? Your answer reveals your comfort with risk. If you're saving for a short-term goal, like a vacation or emergency fund, FDs are ideal. But for long-term wealth creation, mutual funds, particularly equity funds, are the way to go. What if I told you that you don't have to choose just one? The smartest investors strike a balance. They allocate a portion of their portfolio to FDs for stability and liquidity, while channeling the rest into mutual funds for growth. This approach combines the best of both worlds, ensuring your money works for you while you sleep peacefully. But remember, the longer you wait to start, the harder it becomes to catch up. Whether it's FDs, mutual funds, or both, action beats inaction every single time. Both FDs and mutual funds have their pros and cons. FDs are safe but limited in growth. Mutual funds carry risks but can help you build real wealth over time. The key is to understand your financial goals, risk tolerance, and time horizon. But here's a question to ponder. What happens if you do nothing? That's the biggest risk of all, not taking control of your financial future. If you found this video helpful, hit the subscribe button and join our journey towards smarter, wealthier living. And don't forget to share this with someone who needs to hear this today. Thanks for watching Naya Note. Remember, the best investment you can make is in your own financial education. See you in the next video.